Welcome back to the Deep Dive. Today we are strapping ourselves in for a deep descent into the often overlooked and frankly historically troubled world of regional telecommunications. But we aren't here to dwell on old copper wires and outdated infrastructure. We are here because we're following the footprints of a giant, one of the smartest capital allocators in history, who just signaled a massive high-conviction bet on a company that, very few people are talking about.
That's exactly right. Our mission today is sort of a structural reconnaissance. We've synthesized a whole stack of Q3 2025 earnings transcripts, analyst reports, and the latest investment commentaries.
Okay.
And they all center around the really dramatic ongoing corporate overhaul of a company called Telephone and Data Systems, or TDS. For years, this company has suffered from what the market calls the conglomerate discount.
And that's the core of our inquiry, right? Why are we dedicating a deep dive to a regional player that has traditionally been, well, an out-of-favor stock?
Yeah.
It's because when Howard Marks of Oaktree Capital, the man who literally wrote the book on value investing, takes a position, you stop.
You pay attention.
You pay attention. He just made a significant high-conviction bet on this exact name.
And Marx doesn't buy noise. He buys structural simplification and, deep hidden asset value. So our mission in this deep dive is to methodically unpack the entire complex transformation of TDS.
Okay.
The move from a troubled, diversified regional telecom into a much more focused digital infrastructure holding company. We need to identify what Marx saw that suggests such a substantial undervaluation and map out the quantifiable path to that projected, say, $52 fair value, which implies an upside of, potentially over 30%. This is not just a stock story. It's a blueprint for corporate rebirth.
Okay, let's unpack that signal, because this is where the story shifts from being just technical to being, strategically compelling. When an investor like Howard Marks, who is known for his focus on credit cycles and deep value, starts buying, especially in a messy situation that the general market is actively ignoring or even punishing, you have to assume there's a deeply misunderstood structural shift in play.
Absolutely. And we have to start with the magnitude of the position, because the size here is the loudest signal. According to his latest 13F filing, the purchase of TDS shares reached 3.05% of Oaktree's entire portfolio.
3%, that's not a small bet.
It's a declaration. In institutional money management, where safety and diversification are, paramount, crossing that 3% threshold, it screams high conviction.
Right.
It signals that Marx believes the potential return here is massive enough to be material to the entire fund's performance, not just some peripheral bet he's making.
And what's fascinating here is the timing relative to the stock price. The sources indicate that even after this huge purchase, the stock was trading slightly below his reported entry price.
Yeah, around 3% lower, according to some analysis.
So he bought in, and the price dropped a little, but he's still holding or maybe even adding. That just flies directly in the face of momentum trading.
It perfectly embodies the classic Marx trade. I mean, he is not looking for a quick profit driven by market sentiment.
No.
He is systematically targeting asset-rich businesses that are currently out of favor with the market because they're complex or misunderstood or suffering from temporary operational headwinds. And historically, TDS was all three.
All three.
Complex, burdened by a subscale wireless operation that's U.S. Cellular, and suffering from low margins compared to the industry giants. The market just couldn't easily value the combined entity, so it slapped a crippling conglomerate discount on the whole thing.
So the thesis for Marx isn't about hoping the telecom sector suddenly heats up. It's about recognizing that the underlying value of the infrastructure assets, the towers, the fiber lines, the spectrum, are just fundamentally worth more than the current market cap.
Yes, especially now that the company is undergoing this massive strategic simplification.
Right.
The core assumption is that the market hasn't correctly priced the value that was unlocked by the recently completed corporate restructuring. Marx is looking past the current noise, the inevitable revenue miss in Q3 from the sale, the temporary spike in wind-down costs, the ongoing CapEx burn.
And focusing on what's left.
Exactly. He's focusing on the pure play assets being revealed. And what you are left with are two very distinct, highly valuable segments: stable, predictable digital infrastructure cash flows, and a high-growth, government-subsidized fiber business. That separation is the key to unlocking the whole valuation.
Okay, so let's get into that pivot. To really appreciate the scale of it, we probably need a bit of context on the company itself.
Yeah, we have to look back briefly. TDS was founded way back in 1969. For decades, it was the, quintessential diversified regional provider, but its complexity and financial strain came primarily from its heavy reliance on its 82% owned wireless subsidiary, US Cellular.
And that wireless subsidiary wasn't just complex, it was the historic operational drag on the entire company. Why couldn't U.S. Cellular compete effectively?
It was a scale problem, plain and simple. In a market dominated by three giants, Verizon, AT&T, and T-Mobile US Cellular was always the fourth or fifth player.
Right.
It operated with dramatically lower margins. While their Tier 1 peers were consistently hitting adjusted EBITDA margins in the mid-30s, US Cellular was stuck down around 20%.
Wow.
So they were always playing catch-up, constantly needing huge capital infusions to upgrade their network in a super competitive, capital-intensive industry, all while lacking the subscriber density of their rivals. It was a vicious cycle.
We have to talk about the controlling Carlson family here because their historical commitment to that dividend streak
Yeah.
for something like 49 consecutive years of
Yeah.
increases.
Yeah, 49 years.
And the dual-class share structure basically made any structural change impossible for years. This was a really entrenched legacy situation.
That dividend streak is almost legendary in telecom, and it speaks volumes about their psychological commitment to just maintaining the status quo. But the most crucial detail that highlights the latent value and the family's historical obstinacy, it dates back to 2007.
Okay, what happened?
Right before the financial crisis, Verizon actually offered a stunning $100 per share for U.S. Cellular stock.
Wait, $100 a share?
$100.
That's almost 3 times what the stock is trading for now.
Exactly, and the Carlsons turned it down. That decision locked the company into that subscale wireless struggle for another decade and a half.
Wow, that single historical decision just highlights the enormous psychological and financial shift required for the family to finally agree to the T-Mobile sale in 2025.
It suggests the external factors, heavy leverage pressure, escalating capex demands for the fiber future, must have finally outweighed the family's desire for control.
Which makes that T-Mobile sale, which closed in August 2025, so definitive. This wasn't just, trimming the fat.
No, it was a fundamental strategic amputation. TDS sold U.S. Cellular's wireless operations, the customer base, the retail operations, and selected operational spectrum to T-Mobile. This massive transaction brought in about $4.4 billion in cash and assumed debt.
That $4.4 billion wasn't just breathing room. It was the entire operational shift. How is that liquidity immediately allocated?
Well, it was very strategically deployed in 3 buckets. First, substantial debt repayment to de-risk the balance sheet immediately.
Smart.
Second, a direct return to shareholders via a special dividend, which we can get into. And most critically, the remainder was earmarked for aggressive capex funding for the fiber build.
So the immediate result is that TDS is no longer a troubled, subscale wireless operator trying to compete with giants.
They successfully executed the pivot. The complex entity the market couldn't value is just gone. The company is now a pure holding company focused entirely on 2 continuing, distinct, and high-quality businesses. This is the simplification Marx was looking for.
And this is what allows for that sum of the parts valuation we talked about.
Precisely. The new, clean structure is what unlocks it. We are left with 1, arrayed digital infrastructure. This is the high-margin contracted tower and spectrum assets, the stable foundation.
The utility component.
Exactly, the valuable utility component. And 2, TDS Telecom. This is the high-growth, capital-intensive fiber broadband provider, the growth engine, the future fence. This clear separation is precisely why analysts can now put a $52 valuation on the combined entity.
Okay, so let's start with that stable foundation, because this is the pure cash flow play. Array Digital Infrastructure. That's the new name for the retained infrastructure from U.S. Cellular, rebranded in July 2025. What do they keep, and why is this segment so valuable?
They kept the hard, passive infrastructure. Array is now a pure-play digital infrastructure company that controls over 4,400 cell towers spread across the country.
And in the infrastructure world, towers are gold.
They are universally viewed as gold. They are long-lived assets with very high operating margins, and critically, their revenue streams are secured by long-term inflation-escalated contracts. They're just passive cash flow generators.
The moment of truth for Array came right after the divestiture closed in August 2025. It came with a massive operational catalyst, the start of the Master Lease Agreement, or MLA, with T-Mobile.
That MLA is the revenue anchor. I mean, think about it. T-Mobile acquired US Cellular's customers and needed a physical location to house its network equipment. This long-term agreement immediately transformed Array from an internally dependent asset into an independent, stable revenue generator leased to a Tier 1 wireless giant.
And the results were immediate.
Immediate and stunning. Array's site rental revenue saw a substantial 68% year-over-year increase in Q3 2025, and that's excluding non-cash amortization.
68% year-over-year growth in site rental revenue is. That's unheard of for a mature infrastructure company. It's an enormous validating data point.
It is. It underscores the immediate financial value of transitioning those towers from being used by a low-margin, subscale internal unit to being leased out to a massive, stable, paying tenant like T-Mobile.
So that shift just dramatically improves the operating leverage.
Totally. Before, the towers supported a 20% EBITDA margin business. Now the tower unit itself generates, high 80s to low 90s gross margins on those rental revenues. This phenomenal growth number and margin profile is what allows analysts to value Array like a premium infrastructure utility.
And beyond the towers, Array also kept valuable spectrum licenses. Their strategy here was really sophisticated. Instead of one bulk sale, they're opportunistically selling off licenses to maximize value.
It was a very calculated, patient strategy designed to maximize competitive tension among the remaining carriers.
So they're playing the field.
They are. Instead of just dumping all the remaining spectrum on T-Mobile as part of the deal, Array negotiated separate, major agreements with both AT&T and Verizon. They anticipate approximately $1 billion in proceeds from each of those two transactions alone.
$1 billion each.
$1 billion each. I mean, these airwaves are a finite resource, and they are leveraging that scarcity perfectly.
And we saw solid, confirmed progress on this monetization strategy in the latest quarter, right?
We did. Array announced $178 million in additional spectrum sale proceeds confirmed in Q3 2025, which adds to the total monetization pipeline. So the strategy is clearly twofold. Secure stable, long-term tower revenue from T-Mobile, and then opportunistically sell the remaining airwaves to fund the future growth engine, which is TDS Telecom.
Let's talk financial stability, which is a huge part of the Mark's thesis. Infrastructure companies are often highly leveraged, 5, 6, 7 times EBITDA. But Array set a highly conservative leverage target. Why?
This is a critical point that underpins the whole SOTP valuation. Array's post-divestiture leverage target is a very conservative, call it around 3.0x EBITDA.
Which, for a tower company, is remarkably low.
It is, especially for a pure-play tower company with the high-quality cash flows now locked in by the T-Mobile MLA. Typically, these companies leverage up to 5x, 6x, sometimes even 7x EBITDA to maximize shareholder returns.
So by choosing 3.0x, what are they signaling?
They're prioritizing resilience and minimizing capital costs. This lack of debt premiumizes Array's cash flow in the sum of the parts calculation. It maximizes their flexibility to weather any economic downturn and ensures their tower revenue is essentially unimpeachable. It's a very conservative, risk-averse structure.
Now, before we move on to the growth engine, we have to mention the one operational risk that was noted for Array.
Yes, the risk note. It's the ongoing challenge with DSH Wireless.
Oh, okay.
DIA is disputing its obligations under its existing master lease agreement with Array. This isn't a small thing. It means a material tenant is pushing back.
So that could impact future revenues.
It could. While Array is diversified and the T-Mobile MLA is the major driver, any dispute over existing lease obligations could create unexpected legal costs or revenue hits. It's a key detail to monitor, though right now it doesn't fundamentally derail the overall tower stability thesis built on that T-Mobile contract.
Got it. Okay, so if Array is the stable, predictable utility check coming in every month, where is the serious upside? That brings us to pillar 2. TDS Telecom.
Yes, the primary source of future value creation and the growth engine. This business is defined by an aggressive, all-in commitment to fiber build-out.
And aggressive is an understatement. The sale of US Cellular didn't just maintain the existing growth targets. Management immediately used that clean slate and capital infusion to significantly increase its long-term goals.
Their confidence is enormous, and it's fueled by that $4.4 billion liquidity event. The new long-term goal for marketable fiber service addresses was significantly increased by 50%.
50%?
Yeah, jumping from a previous target of 1.2 million to 1.8 million. This expansion requires massive, sustained capital expenditure. but it confirms that fiber deployment is now the absolute singular priority of the entire holding company. They are fundamentally transforming into a fiber company.
And this isn't just about, throwing fiber down the road. They're prioritizing superior technology. What does the long-term vision look like for speed and getting rid of the old copper lines?
The vision is a complete technological overhaul. They aim for 95% of their total footprint to offer speeds of at least 1 gig, a huge jump from the 74% they currently offer.
Okay.
And at the same time, they're aiming to reduce their reliance on the antiquated, vulnerable, legacy copper infrastructure to just 5% of their total addresses. It's a massive multi-year CapEx commitment to becoming a premium next-generation provider.
So looking at Q3 2025, how is their execution velocity on these ambitious targets? Are they actually moving fast enough to justify this growth thesis?
Well, the company demonstrated solid execution velocity. They hit the milestone of deploying 42,000 new marketable fiber service addresses in Q3 alone.
42,000.
Yes. And that pushed them across the 1 million fiber address milestone overall. This deployment directly translated into strong customer acquisition. 11,200 residential fiber net additions in the quarter, which is 19% year-over-year growth in that fiber segment.
But the sources flag that hitting 42,000 in Q3 might not be fast enough to meet the overall annual targets. There's an execution challenge here.
That's the critical fine print. The company has a stated annual goal of deploying 150,000 new marketable fiber service addresses for 2025.
Okay.
Hitting 42,000 in Q3 means they were only about halfway to the goal through the first 3 quarters. That suggests a massive ramp-up in effort is necessary in Q4 to meet the full-year target.
So execution risk is the main concern.
It remains the primary operational concern, the ability to hire enough crews and manage supply chains to maintain that 150,000 annual passings pace.
This brings us to the financial bedrock underpinning this entire CapEx plan: federal funding. The scale of this build-out, especially in high-cost rural areas, wouldn't be possible without the Enhanced Alternative Connect America Cost Model, or ECAM.
It's the subsidy lifeline that transforms the economics of the entire rural build. TDS is set to receive approximately $90 million per year for 15 years through this program.
$90 million a year for 15 years.
It's a huge, predictable stream, and these funds are highly targeted. They're explicitly for supporting builds in their rural copper footprints, underwriting about 300,000 of the fiber passings.
So what does that mean financially?
It means the government is essentially subsidizing the most expensive, economically challenging areas. EACAM allows TDS to recognize a steady, predictable revenue stream up front, which significantly improves the payback period for that expensive fiber infrastructure. It just reduces the hurdle rate for those rural builds.
And this leads us to the most significant regulatory de-risking event of the entire investment thesis, which happened just this past summer.
Absolutely. The Supreme Court ruling in June 2025, it involved a constitutional challenge to the entire funding structure behind EACAM.
Right. There were arguments that the FCC had too much authority.
Exactly. The challenge argued, using theories like the non-delegation doctrine, that the structure was unconstitutional.
And the Supreme Court validated it.
They did. The ruling affirmed the constitutionality of the funding mechanism, and that just removed the single most substantial legal risk hanging over TDS Telecom's entire fiber expansion plan.
So if you're Howard Marks, you're looking at a company that not only raised $4.4 billion by selling a problem asset, but also just had the legal certainty of its long-term $90 million annual funding stream validated by the highest court in the land.
That regulatory certainty is what allows management to commit to that 50% increase in the fiber address target. It's a massive de-risking event.
Okay, so despite the ambitious subsidized fiber targets, TDS Telecom remains a dual-speed business for now.
Yes, and we have to address the inherent tension here between the successful fiber growth and the persistent, costly decay of the legacy copper and cable systems.
The numbers confirm this struggle for balance. What are the metrics showing us about these internal dynamics?
Well, on the positive side, the fiber momentum is financially clear. Residential revenues per connection stood at $65.66 in Q3 2025. That ARPU is directly driven higher by fiber customers who subscribe to faster, more expensive speed tiers.
So fiber adoption is clearly good for the top line.
It's the profit engine of the future. But the legacy base is still shrinking, and that means they're fighting a race against attrition.
And how bad is that attrition?
While FiberNet ads are strong, the overall subscriber base is shrinking. Total residential connections stood at 921,100 in Q3 2025, which is down year over year, More critically, the company lost 13,100 total subscribers from its legacy copper and cable footprints throughout 2024.
So that puts enormous pressure on the fiber build team.
Enormous. They have to accelerate conversions and expansion fast enough to not just offset but exceed those losses and begin showing overall network growth.
And if that's the internal tension, the external threat is the most disruptive force in telecom right now. Fixed wireless access, or FWA.
FWA has changed everything, especially for legacy providers like TDS. Industry data confirms that FWA has captured basically all net broadband subscriber growth since mid-2022.
And that's coming mainly from T-Mobile and Verizon.
Exactly. It's a lower capital intensity solution that uses their existing mobile infrastructure to offer a good enough service at a competitive price.
And where does FWA hit TDS the hardest?
It directly targets their most vulnerable asset, the copper DSL base. Copper DSL is slow, asymmetrical, and often unreliable. FWA provides a faster, easier-to-install service, making it a very easy switch for unhappy copper customers. It's an existential threat to their legacy revenue stream.
So the defense strategy is entirely dependent on the technological superiority of fiber.
Precisely. They are in a race against FWA encroachment. TDS has to accelerate their fiber build-out because the only way to compete effectively is with better tech.
Right.
FWA has limitations, mainly backhaul capacity and congestion, so it can't consistently deliver high symmetrical speeds. TDS Fiber, offering symmetrical speeds up to 8 gig, is a differentiator FWA just can't match. They're betting that once a customer moves to fiber, FWA can't pull them back.
So they're spending aggressively now to stave off competitive loss later. Are there any other temporary financial headwinds we should be aware of during this massive transition?
Yes, the market needs to be prepared for some temporary pressure on margins. Management anticipates high SG&A expenses will persist through the first half of 2026.
And that's from the wind down.
Purely associated with the wind down of the legacy wireless operations, integration costs, severance payments, contract terminations, stuff like that. So the market has to look past this short-term pressure to see the long-term margin improvement once the transformation is complete.
Okay, let's turn to the financials. Because Q3 2025 provides the first clean look at TDS as a continuing operations business. And as we said, it was a mixed bag, which probably explains some of the undervaluation.
Highly mixed. It really illustrates why the market hasn't fully digested the shift. The top line was naturally down year over year because, they sold 82% of the company's historical revenue stream. Net sales were $308.5 million, and that missed the Zacks consensus estimate by a significant $94 million.
So if you're just looking at revenue, you'd be concerned.
You'd be rightly concerned, but the profitability picture is a total reversal. This is the success story of the restructuring.
This is what Marx is buying into.
Exactly. The strategic exit of the unprofitable wireless business resulted in a profound shift from loss to income. Net income from continuing operations was $57.5 million, or 33 cents per share.
And that's compared to what?
A reversal from an $83.1 million net loss in the prior year quarter. Adjusted EPS beat estimates by 13 cents. It shows that while they shed massive revenue, they shed even larger operational burdens, which immediately cleaned up the bottom line.
And if we drill down into the segment EBITDA, that confirms the structural value we talked about.
It does. Array Digital, the tower company, is doing the heavy financial lifting right now. Its adjusted EBITDA surged to $85.1 million, up from just $34.2 million year over year.
Wow.
That stunning growth from the T-Mobile MLA translated directly into high-margin profit, cushioning the overall financials. Meanwhile, TDS Telecom adjusted EBITDA saw a slight decline, $80.5 million versus $82.8 million, which is a clear reflection of the intense CapEx and the drag from legacy losses.
The debt side is crucial here. They used the T-Mobile proceeds to immediately de-risk the balance sheet, opting for a highly conservative capital structure.
It was a conscious choice for low leverage to fuel that growth engine. After the U.S. Cellular sale, they paid down a substantial amount of debt. Management set incredibly resilient leverage targets. The TDS parent company is targeted at an extremely low 1.5x leverage.
1.5 times.
And Array is targeted at about 3.0x.
In a rising interest rate environment, that level of conservatism has to be a massive strategic advantage.
It is the ultimate risk mitigation strategy. It minimizes their capital costs, ensures maximum resilience, and maximizes the cash flow that can be reinvested into the network expansion. They're projected a massive CapEx of $375 to $425 million for 2025 alone.
And that low debt ensures they can fund it.
It ensures they have the flexibility and capacity to aggressively fund this, regardless of market volatility. The mission is fiber, and the balance sheet is designed to support that mission at all costs.
And finally, management signaled their own confidence in the company's value through aggressive capital returns to shareholders.
Yes, a classic move when management feels the stock is undervalued. They executed a dual-pronged approach. First, Array paid a special cash dividend of $23 per share in August 2025.
A direct return of the proceeds.
Exactly. And second, and maybe more importantly in signaling confidence in the future, the TDS parent authorized an expanded $500 million share repurchase program, increasing the total potential buyback to $750 million.
Which is a clear signal that they believe their own stock is the best investment they can make.
It is. It says management believes the stock is currently undervalued and that buying shares back is the best use of that clean balance sheet cash, right alongside funding the fiber deployment. They are putting their money where their fiber is.
Okay, so let's circle back now to the core of the Marx thesis, valuation.
Yeah.
Why is the stock currently trading around $38 when analysts are seeing intrinsic value around $52?
The answer lies in the complexity we started with. Traditional consolidated valuation metrics like a simple PE ratio just fail here. They don't work because they average two wildly different businesses.
All right, you can't lump together a stable tower company valued like a utility and a capital-intensive high-growth fiber builder valued on future cash flow. So the sum of the part, or SOTP, approach is absolutely essential.
It's the only way to do it. You have to value the two segments using vastly different methodologies. For Array Digital Infrastructure, we use standard wireless infrastructure multiples, a high EV to EBITDA multiple.
Because the revenue is contractual and predictable.
Correct. We apply that to the high margin cash flow from the 4,400 plus towers secured by that T-Mobile MLA. Then we add the confirmed and anticipated $2 billion in spectrum proceeds from AT&T and Verizon as just liquid value.
And crucially, that low leverage on Array enhances that valuation multiple.
Yes, exactly. Because Array is only leveraged at 3.0x EBITDA, its cash flow is viewed as higher quality, less prone to interest rate risk, and so it commands a higher premium multiple compared to a typical 6x leveraged tower company.
And then the TDS Telecom valuation is purely a growth play.
It's valued entirely on future potential, typically using a DCF analysis or an enterprise value per passing metric applied to that 1.8 million target. But the valuation is critically enhanced by that $90 million annual guaranteed EAPM subsidy,
which lowers the cost of the build.
It significantly lowers the effective cost of construction for 300,000 of those rural passings, which directly boosts the expected IRR on that portion of the network.
So if you run the numbers through this granular SOTP model, the conclusion is?
The conclusion is a strong buy. The analyst consensus is clear, and quantitative intrinsic value assessments place the fair value around $52 per share.
And at a market price of around $38, that implies an undervaluation of over 27%, maybe up to 34%.
This is the gap Marx is exploiting.
So what specifically is the market failing to recognize right now? Why does this undervaluation exist?
I think there are three primary factors the market has not fully discounted yet, partly because of the short-term noise of those wind-down costs. First, regulatory security. The constitutional validation of the EACAM funding de-risked the primary long-term CapEx source. The market hasn't fully internalized that certainty.
Okay.
Second, the quality of the cash flow. The recurring inflation-escalated cash flow from Array's high-margin towers deserves a premium infrastructure multiple that the consolidated stock price doesn't yet reflect.
And third,
execution intent. The accelerated value creation embedded in that new, highly aggressive 1.8 million fiber address target. The market is waiting for sustained proof of execution, but Marx is buying the strategic intent and the secured funding that makes that target achievable.
Let's bring this full circle then. Howard Marks bought a company that has successfully de-risked its balance sheet by offloading a problematic asset for $4.4 billion. It is now deploying that capital into a high-growth, technologically superior fiber project, which is substantially subsidized by the government and legally validated, all while being underpinned by high-quality, high-margin tower cash flow from Array.
The thesis is structurally sound. It's incredibly attractive from a value perspective, but the entire investment hinges on a singular factor: execution velocity.
The build-out speed.
Specifically, TDS Telecom must sustain the delivery of 150,000 new marketable fiber addresses annually and achieve high take rates in those new markets fast enough to generate meaningful revenue.
And if they can't?
If they can't, then the primary quantifiable risk to those bullish $52 projections is simply failing to accelerate fiber growth fast enough to counteract the ongoing inevitable operational drag from the shrinking, decaying legacy copper business. If the fiber build stalls or execution lags, the investment thesis unravels. It turns a high conviction value play into a high cost turnaround headache.
So it's a classic patient value play, betting on management's ability to successfully finish the transformation they started.
Indeed. And it raises a final provocative question for anyone considering the future of rural infrastructure investing.
Okay.
TDS's strategy relies so heavily on the subsidized E-ACAM build-out in rural America. If this high-speed symmetrical fiber offering allows them to consistently capture market share and it proves the profitability of fiber even in these historically high-cost, underserved rural areas, does this model fundamentally change the calculus for investing in rural digital infrastructure going forward?
You mean if the government subsidy effectively proves the sustainable economics of the last mile?
Does it open the floodgates for further private capital investment in traditionally neglected markets?
That's certainly something for all of us to consider as we watch how TDS manages that aggressive 1.8 million fiber target. We hope you feel thoroughly informed on the complex transformation of TDS and the high conviction move by Howard Marks. This has been The Deep Dive.